On this vote, the yeas are 222, the nays are 209. The bill is passed. The motion is adopted.
The longest shutdown in U.S. history is set to end, but fully reopening the government could still take days, and some fear the economic impacts could linger for a long time to come. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released.
As the markets turn their attention to the Fed, the White House says key October data may never be released, fueling uncertainty around monetary policy. Oil holding losses after OPEC says crude supplies have surpassed demand sooner than anticipated, with Brent falling towards $62 a barrel. Jim Bianco, founder and president of Bianco Research, will be joining us with his outlook for the broader markets as investors grapple with uncertainty. We zero in on the currency markets with Barclays head of Asia FX and EM macro strategy, Mittal Kotecha, plus the MD and CEO of Biocon Biologics discusses their plans for a possible IPO as reports emerge of a merger in the works with parent company Biocon. President Trump is expected to sign a stopgap funding measure to reopen the federal government after the bill was passed by the House earlier today. But the White House is warning of the lingering impact from the longest U.S. shutdown in history.
The Democrats may have permanently damaged the federal statistical system with October CPI and jobs reports likely never being released. And all of that economic data released will be permanently impaired, leaving our policymakers at the Fed flying blind at a critical period.
And that was White House Press Secretary Caroline Leavitt. In the markets, it's a pretty flat day for Asia. With the U.S. earnings season nearing completion, markets, not surprising, shifting the focus to the Fed and the outlook for potential interest rate cuts. MSCI Asia-Pac Index flat right now. We have the CSI 300 Index, though, inching upwards, up by 0.6%. The dollar index currently flat at 12.17 and change. Now let's get perspective from Jim Bianco, founder and president at Bianco Research. Jim, your thoughts on what's happening? Yes, the shutdown may be over, but no, you may not be getting your data anytime soon. That economic fog continues.
Yeah, it will continue, at least at the government side. They'll probably go back to work on Monday, would be my guess. They'll probably put out the September payroll report, which is now 5 weeks late because that was done before the shutdown. There won't be an October report. And then they're going to have to make a decision, because if there is going to be a November report, it's going to be a 2-month change. It's not going to be a 1-month change. And how are they going to handle that? And how are we going to interpret a 2-month change in CPI and a 2-month change in payrolls? So we're going to be dealing with the government data for a number of weeks until we finally figure out which end is up with it. Now, I don't think it's that catastrophic that we don't get government data. It is for the Fed because they base their decisions off of it. But we've got plenty of private sector data. We've got earnings reports that can paint a picture of where the economy is without the government data. And it's painting a picture of an economy that's okay. It's not great. Excuse me. It's not great. It's not terrible. It's somewhere kind of in the middle. And inflation is a little bit stickier than the Fed would probably like. And that's ultimately where we're at right now.
If it's okay in terms of the economy, how do you see the Fed moving in terms of monetary policy? We heard from Myron. He's calling for perhaps a 50 basis point cut. The market's pricing in 65% for a 25 move. I mean, when you take a look at the labor market easing, is that enough for a 25?
You know, that's a good question. And I would also throw in that there's been a shift at the Fed, something that we haven't seen in decades. We're all accustomed to the Fed being an autocratic institution. The chairman decides what they're going to do. Everybody falls into line and agrees with the chairman. That might not be the case anymore. They're fracturing into a bunch of different groups. We could see multiple dissents in both directions at various meetings. We might even wind up seeing policy being passed with 7 or 8 votes as opposed to 11 or 12 that we're kind of accustomed to right now. So it's not clear which way the Fed is going to go because it's not clear who we should be listening to at the Fed because there's multiple voices. Now, ultimately, I think this is a good thing. I never was comfortable with the way that the Fed was running before. I like the idea of more independence and heterodox thinking at the Fed. That said, I would think if I was a voter on the Fed, I would vote to not move rates, not cut rates in December. I think the economy, as I said, it's okay. Inflation's a bit of a worry. There's still some tariff-induced price hikes coming. I don't think this is the time to be cutting interest rates any more than they already have. But I suspect, as you pointed out, the markets are kind of leaning towards the Fed cutting rates, that's what they'll actually wind up doing, unless once the statistical agencies open, if we get some really strong data to change their opinion.
So you're suggesting that a 25 move might backfire. How might this play out? What might the implications be, not for the markets, but the economy?
Well, all you got to do is look back a year ago. The Fed cut rates in September of 24 by 50 basis points in their first meeting and followed up by 225s. And what happened was long-term interest rates rejected it. They were worried that they were stimulating into inflation, and they went straight up. It slowed down the housing market because mortgage rates went up, and that would be a very big deal right now because the focus in the U.S. right now is on the affordability in the housing market and about trying to bring long-term interest rates down. But if the Fed winds up cutting rates and the market winds up thinking, no, we don't need that, you're just going to stimulate us into more inflation, you could wind up with higher interest rates like you did last year.
So where do you see yields headed? I mean, they're inching higher. It wasn't that long ago when they talked about how, 10-year yields are not going to be above 4.
Yeah, I'm still of the opinion that we're in a long-term secular rise in interest rates. It started in 2020. We hit 5% on the U.S. 10-year note in 2023. We've been trending sideways for the last couple of years. I think once we break out of this long sideways action that we've been in for 2 years, that it'll probably be higher on the back of economic strength and on the back of stickier or uncomfortable inflation. I use that word uncomfortable. I'm not saying we're going to have roaring inflation, but when a Federal Reserve is trying to target 2 and you wind up with 3 to 3.5, that's a problem. And it's a problem for the bond market because that would imply 5% interest rates or slightly above 5% interest rates on the long end of the yield curve where we're closer to 4 right now. And so that could push up interest rates as we go forward.
Jim, when it comes to returns, how should investors be looking at it? For the last couple of years, we're seeing equity market returns in excess of 20% or more. Is it time for us to perhaps adjust, our expectations? Could it be an era of lower returns? How are you looking at returns?
Yeah, I think it's going to be an era of lower returns, but not low returns. What we've been accustomed to, 23 and 24 with the S&P 500 returning more than 20%, is that somehow that's normal. That's not normal. Those are extraordinary years. This year, we're up about 17%. But if you actually break down the S&P, what you'll see is that the majority of the gains have become from AI and AI-related stocks. Only about 4 or 5% of the S&P's 17% return has come from everything else. About 12% of the S&P's return has come from AI-related. And so when you break that down, I think where we're stuck is I've termed this the 4, 5, 6 markets, that over the next year, 2 or 3, cash will return as 4, bonds will return as 5, and stocks, let's say less AI, because that's kind of a separate category in the stock market, will return us around 6. Well, this year cash is returning 4, bonds are returning a little bit better at 7, and XAI stocks are returning about 7%. Those are actually not bad returns. But I think a lot of investors look at that and go, what's wrong with the market? Why is it only 7%? That's pretty normal. What we've been seeing for the last couple of years has not been normal, and I think there's an unrealistic expectation there.
What's the risk for that projection? I mean, there are lots of uncertainties out there. I mean, just in terms of inflation, it's yet to fully play out. It's still sticky, and the impact of tariffs have yet to fully bite.
Yes, there is that. There is the disruption that AI may or may not, implore on the labor market, and whether or not it's going to, fulfill that doom scenario that you heard, that 50 million jobs could be replaced by AI and 160 million jobs in the United States to begin with. There's also the potential of recession. There's potential of geopolitical tensions. All of these things could come in and upset this apple cart. But short of one of those exogenous events coming in, I think that probably the most realistic risk is the risk of stickier to higher inflation and keeping interest rates up. That may not bother the AI stocks because they have such big growth potentials. Whether they borrow 4, 5, or 6% doesn't matter. But for the rest of the economy, it does matter. If you're running a restaurant or if you're running a retail store, if interest rates go up 100 or 200 basis points, that's going to really impact your business.
Jim, if you're expecting lower returns from the U.S. market, I'd imagine that you'll be looking elsewhere, right? You want to diversify. It does make sense to be looking at Asia.
It does, but it depends on your point of view. If you're an Asian investor, I would say yes, you'd want to look to Asia. You'd want to probably think about Asia. Japan has been a fairly good place to be this year. But if you're an American investor and you're looking to Asia, what you're probably going to have to consider is that if interest rates stay sticky and go up, we've recoupled interest rates with the dollar. The dollar will probably stay stronger too. So you'd be getting into a weaker currency in general with higher U.S. interest rates. So that would be the offset if you're a U.S. investor. If you're an Asian investor, I think you'd probably be, looking at nearby in your own country or nearby countries before the U.S.
And Jim, how should your portfolio be looking like right now? And what role should gold play in that portfolio, given the conversation we just had?
Gold is going to have it has had a fantastic year. It's up almost 60%. Silver's up almost 80% on the year. I think it's going to continue to perform very well. Gold is a hedge. It's a hedge against something going wrong. Something going wrong could be inflation. It could be political strife. It could be a multitude of things. It could be a pandemic. And so I think in this uncertain environment, with the political tensions that we see, with the risks on the horizon, wars that we've got as well, that gold will play a good spot. A small position should always be warranted in it, especially more now than ever.
And what's your view on the dollar, Jim? I mean, we were all expecting the dollar to weaken from here. Of late, in the past few months, it showed resilience. Is that resilience going to continue?
Yeah, it's been a 3-act play with the dollar. I mean, first, up until Liberation Day in April, the dollar was kind of tracking with U.S. interest rates. If they went up, it strengthened. If they fell, it weakened. I'm speaking generally like by the dollar index. Then after Liberation Day and during the tariff wars, the dollar decoupled. It fell even though interest rates were going up. And we called that the loss of American exceptionalism or the debasement trade or some other words. Well, that only lasted for about a month or maybe 6 weeks. And then it recoupled with interest rates at a lower level. And so now we're back to this whole idea of where are relative interest rates going to go when you start looking at the currency. And if the U.S. is going to continue to see interest rates trend higher, as I think, it means the dollar is going to stay stronger.
So what assumptions are you making about Fed moves in 2026, and how will that play into the dollar?
The Fed moves, the big assumption you have to make is Chairman Powell will no longer be the Fed chairman after May. The next person in, whoever it happens to be, I think Kevin Hassett, the Council of Economic Advisors chairman, or National Economic Council chairman, is going to be the leader, to replace him, is going to come in with a mandate to cut interest rates and cut interest rates aggressively. Whether that's the right decision or not, well, we'll see where the economy is middle of next year, second half of next year, when the new Fed chairman gets in. But I suspect that it will be okay and that an aggressive cutting rate will be a mistake. So when you look at markets, what are they pricing for the Fed? A lot of people say to me, well, the market thinks we're going to see 4, 5, or 6 rate cuts by the end of next year. That's not necessarily because it's what the market thinks is the right policy. It's really what it's pricing in is a new guy's going to come in with a mandate to cut rates. So it's expecting that. It's not maybe passing judgment on whether or not it's going to be the correct policy.
Jim, as we speak, we're seeing President Trump signing that bill. He did say that he will sign it. He is, well, speaking at this point in time, we're waiting for him to sign. I'm just wondering what the optics are for you, Jim.
Well, I think that, it's good that we finally got this behind us, this shutdown. It's been disruptive. It's been unsettling. Right. And I'm happy he's signing the bill. But let's keep in mind that this is what they call...
Jim?
Yes.
Hang tight. We're going to listen to the president right now. Hang tight, okay?
A country illegally, from gangs, from prisons, from mental institutions. They wanted to pay them $1.5 trillion, which would have really hurt our healthcare businesses and our recipients at levels never seen before. Today, we're sending a clear message that we will never give in to extortion, because that's what it was. They tried to extort. The Democrats tried to extort our country. In just a moment, I'll sign a bill exactly like we asked Democrats to send us all along, many days ago. This cost the country $1.5 trillion, this little excursion that they took us on. Republicans never wanted a shutdown and voted 15 times for a clean continuation of funding. There's never been a time when one or the other party ever didn't sign a continuation. It's just a continuation, not a big deal. It's a continuation, and we'll talk later. Yet the extremists in the other party insisted on creating the longest government shutdown in American history, and they did it purely for political reasons. I want to thank Speaker Mike Johnson, Senate Majority Leader John Thune, as well as House Majority Leader Steve Scalise, Majority Whip Tom Emmer, and numerous other great Republican leaders and congressmen and senators who are here and frankly spent a long time in Washington getting this thing to go away. I also want to thank the broad coalition of Americans that stood with us in this fight to reopen government, including the Teamsters, the American Federation of Government Employees, the Fraternal Order of Police, AMVETS, the National Small Business Association, the American Farm Bureau, the American Trucking Association. These are all incredible patriots. The Airlines for America, the Allied Pilots Association, the National Air Traffic Controllers Association, and many others, unions and non-unions. Over the past 7 weeks, the Democrats' shutdown has inflicted massive harm. They caused 20,000 flights to be canceled or delayed. They departed so many times, so late. People were hurt so badly. Nobody's ever seen anything like this one. This was a no-brainer. This was an easy extension. But they didn't want to do it the easy way. They had to do it the hard way. And they look very bad, the Democrats do. They deprived more than 1 million government workers from their paychecks and cut off food stamp benefits for millions and millions more Americans in need. They caused tens of thousands of federal contractors and small businesses to go unpaid. And the total effect of the damage their antics caused will take weeks and probably months to really calculate accurately, including the serious harm that they did to our economy and to people and to families. So I just want to tell the American people, you should not forget this. When we come up to midterms and other things, don't forget what they've done to our country. I also want to call for a termination to the filibuster so that this can never happen again. If we had the filibuster terminated, this would never happen again. And don't forget, we have another date coming up in the not too distant future. We can never let this happen again. And we should be able to pass great, really great legislation. So I say terminate the filibuster because, by the way, the Democrats will do it immediately if they ever assumed office, which hopefully they won't. Today we had the highest stock market price ever in all of the different markets. We set a record. It's the 48th time in the 9 months that I've been in office that we had this record set. So think of that, 48 times we had a record set, but today is the highest of them all. We're going to break new grounds. Nobody would have thought. I have with us not only the great political leaders, but the great business leaders of our country. They're standing right behind me and right really alongside of me. And if we would have told them a year ago that we'd be having stock prices this high, none of them, in fact, I just asked them that question, none of them would have believed it. And that inures to jobs and, very importantly, to 401ks, which have also set a record today, a record high for the people that have 401ks. And also, I want to thank Walmart because they came up with a fantastic study. It was the cost of Thanksgiving coming up and the cost of Thanksgiving from a year ago under Sleepy Joe Biden, and we're 25% lower this year than we were a year ago. And it's a very inclusive report, so I want to thank Walmart. They've done it for many years, but we believe in that, and we believe in that company. I want to also thank the 8 Senate Democrats who finally did the right thing in voting to end this craziness, this madness, but unfortunately the vast majority of congressional Democrats were happy for millions of Americans to suffer. They really did suffer, too. And the Democrats admitted, they said, well, no, we finally have a point. Even though people have to suffer, we finally have a point, and that didn't work out too well for them. But they really went out and they could appease the fringe benefits of their far-left base, but that didn't work out because now their far-left base is angrier than ever before. We actually elected a mayor of New York City who happens to be a communist. When was that going to happen? Remember, I said all the time during my campaign, we will never be a socialist country. And that's right. We turned out to have a communist in New York City. And if you look at his views, those are the views of a communist, not a socialist. So this is no way to run a country. I hope we can all agree that the government should never be shut down again, end the filibuster, terminate the filibuster. It'll never happen again. So with my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again for all Americans. Again, costs are way down. Energy is way down. Gasoline is at $2.50 a gallon versus $4.70 for the Democrats. And we think we're going to hit pretty close to $2 a gallon. That's like a really massive tax cut. It's the equivalent of that. And speaking of tax cuts, our great, big, beautiful bill is giving everybody in our economy, middle income workers, low income, everybody, the biggest tax cut in the history of our country. And it's no tax on tips, no tax on Social Security, and very importantly, no tax on overtime. You work overtime, there's no tax. That's among the things that add up to the biggest tax cut in history. And one other thing, you hear about rich people with deductions. Well, when you buy your car and you borrow money, you're allowed to now deduct the interest on that loan. So you can take that interest deduction, and what you can take is that interest payment and deduct it for income tax purposes. That's a tremendous tax cut right there. But it all includes fixing the health care system that Democrats broke with the disaster known as Obamacare. Obamacare was a disaster from day one. It's done nothing but go up. And if you remember President Barack Hussein Obama, when he came up with this crazy idea, he said everything's going to be great, rates are going to go down, payments are going to go down, everything's going to go down. It went the exact opposite, with the biggest increase of healthcare in any country. It's a disaster. And I'm calling today for insurance companies not to be paid, but for the money, this massive amount of money, to be paid directly to the people of our country so that they can buy their own health care, which will be far better and far less expensive than the disaster known as Obamacare. And I've had, I think, great support. I've even had Democrat support. So we want the money that would be going to the insurance company, which is hundreds of billions of dollars. Their stock prices have gone up by 1,000% in many cases, 1,000% over a short period of time, because our country stupidly pays them so much money with this Obamacare scandal. So I want the money to go directly to you, the people. And you go out and you'll buy your own health insurance, and you'll negotiate different plans, and you'll get much better insurance, and you will be an entrepreneur for yourself. So I'm always willing to work with anyone, including the other party. We'll work on something having to do with health care. We can do a lot better. We can do great. So much money is involved, and we're willing to pay so much money to the people. So we're going to pay a lot of money to the people. They're going to go out and buy their own health care, and we're going to forget this Obamacare madness. So with all of that, I just want to tell you the country has never been in better shape. We went through this short-term disaster with the Democrats because they thought it would be good politically. And it's an honor now to sign this incredible bill and get our country working again. Thank you. Okay, thank you very much. I don't know if you have questions. I think we really have a really great situation. We have a country that we love, and we have a country that's in great shape. As you know, we have now it's over $18 trillion invested in our country by other people and countries. That's a record. There's never been a country that had so much. And that money's going into also building new auto plants, new AI plants, new everything. We've never had a time like this. Thank you very much, everybody. I appreciate it. Thank you very much.
Thank you guys for going. Thank you.
It's a great day. Well done, Mr. President.
And that was President Trump signing the bill that would end the government shutdown in the U.S. He talked about how he wants to make America great again, make America affordable again, that the shutdown should never happen again. In fact, he says that he wants, he's repeating the call to terminate the filibuster rule in Senate, and that he wants to thank Walmart for the cost of Thanksgiving study. Again, he talked about how a great shape the U.S. economy is in. It's never been better. The stocks market have also never been higher. Let's get Jim Bianco back and get his reaction from the remarks we heard from the president. Jim, your key takeaway?
Two, this is a continuing resolution. It ends on January 31st. So it only opens the government for 80 days. During those 80 days, they have to negotiate a long-term agreement and deal with health care. It's uncertain whether or not they're actually going to get all that done. We could be right back here in February, where we were before he signed this bill. The second one is he called for the end of the filibuster. What that means is that to end the debate in the Senate, you need 60 votes, not 51 votes. That has been a very good tool for many decades to keep the Senate from wildly passing legislation back and forth. The fear is if you get rid of the filibuster, president comes in, here comes dozens of new bills, new laws, new president comes in, get rid of the old president's laws, here's a new set of laws, and we just keep going back and forth and making the government disruptive. I'm against them getting rid of the filibuster, and I hope they don't.
It does sound like we are kicking the can down the road. The uncertainties will remain. How should markets play that? How do you position, or do you need to hedge even more on the back of that?
Well, I think for the market standpoint, it is a short-term thing. It's, the stock market is higher now than it was back on September 30th when the shutdown started. Didn't seem to be very much bothered by it. I suspect that as we go through the next 80 days, it's not going to be bothered by that as well either. Because at the end of the day, the government has to reopen at some point. It can't stay permanently shut, although I know a lot of libertarians that would not mind that at all. And so the market's not going to get too worried that there's going to be anything. Also, the administration under a Republican and under Trump, when we shut the government down, seeks to minimize the damage that it does, whereas maybe under a Democrat, and I'm thinking like Obama when we had shutdowns 10 years ago, they sought to maximize the damage to inflict political pain to get it over with as quickly as we can. So if there is going to be another shutdown in February, it'll be much like the month of October was, where we were saying there was a shutdown, but most people looked around and said, nothing's really changed. It wasn't until we got into November that things started to change. So I don't think that it's going to be a big concern for the markets, at least now. Maybe if we shut down the government for another month, that would be the earliest March, we could start worrying about it having implications, but that's still too far down the road.
What's changed in the market this week actually is the sentiment towards AI. We saw AI jitters, and perhaps it's a good reminder for people that, all the optimism surrounding AI could be trumped by macroeconomic risks or concerns. This could get ugly, you think?
Yeah, I mean, there is that real risk. I think what's happened with AI is we've started to realize that there's going to be a cost for AI. With the thousands of data centers that are either being built or being planned to be built in the United States, there's been estimates that up to 20% of the construction workforce is going to be working on something AI related, maybe building a road to the AI center, laying the floor, putting on the roof, doing the electrical work or something like that. That's a lot of people it's going to take away from other kind of construction projects. Electricity bills are going up in the United States. In New Jersey, the governor that won, Mickey Sherrill, who won the governor race, won on the argument that she would freeze electricity bills. There's a backlash coming from AI because everybody's in favor of it until they have to pay for it through their electricity bills because of the enormous electricity demands. And I think that that's what's getting the jitters with AI. It's not just all speed ahead, everybody build, let's see how fast we can go. There's no impediments. All of a sudden, there is some impediments, and I think the biggest one right now is energy.
And perhaps earnings. Some say that earnings have peaked. Have they?
It's still too early to say because we're still in the early days of AI. We still have a lot more build out to go. We've got a lot more content to be created. So, no, I don't think, if you talk about the infrastructure companies like the NVIDIAs, of the world, I don't necessarily think that their earnings have peaked. Now, maybe the growth rates have peaked, and with the high valuations that these companies have, that might be good enough to give you jitters. But I still think that there's still solid days ahead for the industry.
So there seems to be a lot of momentum, and it does seem like now the retail investors are providing that momentum. Do you continue to ride it?
Yeah, one of the things that's been really telling about the U.S. markets, and I know this is some case in the Asian markets too, and I'm thinking like South Korea, it's really a case, is that retail investors are dominating. Retail investors are driving the bus. We always used to talk in the financial markets about what's the smart money doing? Well, the smart money might be the millions and millions of retail investors aggregated together, and they're really aggressive in buying this market, and that's why we're up 17%, and that's why AI has been plowing ahead. They've been the big player in the market right now, and I think that they're going to continue to be.
The thing is, Jim, it does seem like you can't fight the momentum, right? You got to ride it. The question is, how do you ride it without getting wiped out at some point in time?
Well, that's the problem. When you want to buy high growth speculative companies, you're going to make a lot of money real fast. You're going to lose a lot of money real fast. That's the bargain that you sign up for when you buy those types of companies. And you got to hope that you make so much money really fast that when you start losing it, you're just losing profits and you're not going to be dipping into your original investment. But these are speculative companies. The biggest problem, I think, with AI, we saw this with the internet 30 years ago as well, is every AI play, whether it's energy, it's capital equipment, it's the Mag 7, other AI companies, they're all priced as if they're all going to win. They all can't win. The market is eventually going to start shaking out and saying there's going to be winners and there's going to be losers. But we're not at that point right now. So the risk you're facing is AI going to be successful? Yes. Are the companies you bought going to be successful? Maybe. But then when people get around that by saying, well, I'll buy all of them. And that's why they're all going up right now. But eventually, once we start sifting between winners and losers, then I think you're going to start to see the indigestion come in investing in this sector.
Jim, it's been great having you with us. Thank you so much for your time today. Bianco Research President Jim Bianco there. Now, still to come on Inside, oil extending its retreat on signs the global glut has arrived in full force. We'll get insights next from SVB Energy International President. Keep it here with us. This is Bloomberg. Well, we just saw President Trump signing the bill to end the U.S. government shutdown now, where the government is trying to get workers back to the Office of Management and Budget telling federal workers to return to work on November 13th. Get back to work, they say, on November 13th. We heard from Trump saying that he wants to make America great again, to make it affordable again in terms of how the futures are looking. S&P futures pointing to a higher open as the U.S. prepares for that government shutdown to end. It is up about 0.1%. Now, National Economic Council Director Kevin Hassett says the implementation of President Trump's tariff policy is an ongoing process and more changes will probably be made along the way. Hassett spoke with Bloomberg host and Carlyle Group co-founder David Rubenstein on what he's learned from Trump's tariff strategy.
He has believed in tariffs his whole life. And a lot of people thought that the tariffs would come in and cause a recession and cause inflation, and his intuition was that they wouldn't, and they haven't. And I think that we've learned a lot about how tariffs fit into an optimal fiscal policy because of him, and I would say that would be a great accomplishment as well.
Now, the tariff policy, is it complete now? In other words, has he finished negotiating the major deals with the countries he wants to negotiate with, or is it still an ongoing process?
It's an ongoing process. Ongoing process. I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. And so I think that there are going to be more changes, and there have been really big changes. And then one of the things that people forget about, like prudent policy making, I'm sure that President Carter would have agreed with this point, is that you do what you think is right, and then you watch what happens, and then when you see things that you need to adjust, you adjust them. And so I would guess that we've made really big changes and that we'll have to make adjustments now.
Now, the theory behind tariffs, I thought, was to even out the trade balance to some extent and maybe raise revenue. But the President has imposed tariffs on countries with which we have a surplus, like Brazil. What's the theory behind imposing a surplus or a tariff on something like Brazil?
The point is that it's really easy to transship, and that if you're going to actually have tariffs have an effect on the U.S. economy, then you need to have kind of a tariff wall around the country. And I could say that that tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space. But for example, if you're a foreign importer that traditionally has sent stuff into the U.S., sold into the U.S., then one of the ways you can get around the tariff potentially is you set up a U.S. subsidiary, and then you have your widget and you sell it to the U.S. subsidiary for, say, $100. And then the U.S. subsidiary will pay the tariff or you'll pay the tariff, but either way on $100. But then the subsidiary sells the product to the U.S. for $1,000, and you avoid $900 worth of tariff. And so tariffs, if you want them to have an effect on the economy, you have to really, really look at how are we really collecting the tariff, and how are we making sure that people aren't transshipping, people aren't funneling things through subsidiaries, and so on. And so I think that that's part of the overall calculus.
And that was National Economic Council Director Kevin Hassett speaking with David Rubenstein, Carlyle co-founder and host of Peer-to-Peer on Bloomberg Television. Let's do a check on where oil prices are right now. Pretty much under pressure on the back of we had that OPEC report saying that global oil supply will match demand in 2026. New York crude currently down about 0.1%. Brent crude also down as we speak. Let's get more on oil markets with Sarah Vakshuri, founder and president of consulting firm SVP Energy International. Sarah, good to have you with us. It does seem like the oil market is recalibrating.
It is definitely a short-term, quick reaction to what OPEC report was today, that next year the market is going to be somehow balanced with a very slight, small oversupply, which is really insignificant. But obviously, in their previous forecast, they were looking into mostly deficit. So that's a reaction to that.
It is about demand and supply. That U.S. government shutdown has weighed down pretty much on consumer confidence, consumer sentiment. With it opening up, will that change the picture in terms of oil demand at all?
Of course, because as you said, it's going to have impact on consumers' confidence and also economy. But also, if you're looking closely, again, this is a very quick reaction and change of sentiment to the OPEC report. But if you look at it, even still the OPEC reports that demand is going to still grow steadily. It's not going to be strong, but it's still growing. And the supply, there's not a huge change that from the previous expectation that is there. Also, there are other factors. We are still not sure about the Russian sanctions, other geopolitical factors. So again, that's a sentiment that has been in the market for long about the glut in the market in 2025 and going through 2026.
How bad will this glut be through 2026, you think?
Well, I mean, if you look at it, I don't think this is going to be significant. Something that we should consider and think about it is that in 2025, the oil prices were not really swinging so much, and they were pretty much stable, particularly in compared to other commodities, which this is actually very important. And it's definitely some of that credit goes to the supply adjustments that OPEC had. Yes, since April, they have been increasing their production, significantly unwinding some of those cuts, but we see that the pattern and trend have been cautious and adjusted to the market. For instance, since October, that the weather was mild. The last quarter, their production increase was slower. They announced that in the first quarter of next year, due to the weather and also the expectation of additional supply and the inventories that are actually high, they're going to pause their increase. But something that I think is important, and market has reacted to that, is that this current today's report by OPEC somehow indicating that while OPEC has been always trying to reiterate the fact that they are adjusting their production based on the market needs, but is also slightly hints that OPEC is not ready or is not going to give up its market share or cut back the production if the demand is around the same expectation, the same volumes growing at the same pace that we are expecting. So the fact that they kind of hinted that they are not going to cut back production or maintain their production as strong along with the non-OPEC production increase, that also has impacted the market sentiment.
So OPEC wants to defend its market share. In terms of prices, though, how low is it willing to go?
Again, we can see it's there are lots of speculation in the market, but still there are so many waiting and looking at the average of 60 or the range of 60 to 65. You have still a lot of questions. Would China continue filling up its SPR? We have this year 2025. Higher than expectation, Chinese stockpiling oil, which obviously adds to the global demand. But also, again, we have the wild card of the U.S. sanctions on Russia. And many expect that if they go to full implementation, is going to cut a significant amount of or considerable amount of Russian oil, which could have impact. So there are a lot of questions to answer. But again, today, we also had another report coming out, and that was IEA's World Energy Outlook that while the OPEC obviously had the impact on the market because it kind of gives out the perspective and prospects of a short-term market, the IEA had a U-turn on their long-term view, which kind of indicates, unlike the previous expectation, which is based on countries' policies, that the oil and gas are not going to peak by end of this decade, and they're going to continue increase the demand for that. And that, in fact, shows that countries' policies and energy strategy has changed toward higher demand, which, again, that's putting it in perspective. Maybe we're talking a lot about short term, what is going to happen in 2026, but looking at the medium and long term, the story would be different.
Right. Sarah, you touched on geopolitics. We know that Ukrainian drones have damaged Russian refining capacity. How much damage has there been, and what impact will this have on the oil market?
Well, definitely the point is that the refinery capacity in Russia, definitely, if Russia cannot allocate that additional the oil that cannot process domestically to export, it's not going to have a significant impact globally in terms of crude oil. Definitely is going to put pressure on Russian products supply to the market, which eventually could have impact slightly on the crude oil. But the point is that this is another, going back to geopolitics, this is another uncertainty in the market, and that's security of infrastructure. And as the Russia-Ukraine conflict's going on, the risk of security of facilities and infrastructure, because the attacks have been so far on refineries, but it could easily be on the exporting facilities, production facilities. These are all aside from sanctions. So again, while we are talking about the glut in the market, we cannot forget about the geopolitical risk, and also the fact that OPEC Plus has already increased their production and unwind many of those cuts. So while we have inventories at a higher level, but OPEC Plus and OPEC generally, the spare capacity that market had in the past couple of years, it doesn't have it. So the spare capacity is much thinner now.
Sarah, lots of speculation on whether or not India has stopped buying cheap Russian oil. We heard from President Trump saying it's not happening anymore. What's your take? What are you seeing in terms of oil flows?
Well, we still see the flows to India, but what is important is that the private, particularly the private refineries, have taken the sanctions more serious. Definitely, there has been a close, India has a close discussion, ongoing communication with the U.S. government, and they are discussing definitely India's energy security is also important. So it might take some time. It might not be a overnight fact that or overnight possibility that India would replace all of this oil that has been going from Russia to India. But we see that mostly the private refineries and those refineries that are exporting products to countries, particularly Europe, US, and Japan, have already changed they stopped or reduced their allocations from Russia. But again, I would say that this is an ongoing discussion between the two countries, definitely India and US, and energy security of India is important. So it's not going to be overnight and imports to India goes to zero, but we see the trend that is decreasing.
Right. And then, of course, it's not just about India. It's also about China and its shadow fleet bypassing, circumventing the sanctions. How is China doing in terms of what it is getting from Russia?
So China has been circumventing sanctions, both, on multiple sanctioned countries. That's Iran, Venezuela, and also including Russia. But China, again, historically, the history of China's complying with U.S. sanctions, I would say China was in full compliance with U.S. sanctions during first term of President Trump. So it's very much, again, two countries negotiation. It's either a carrot or a stick. We can see that it's very much depend on China's will and ongoing negotiations that they have with the U.S. governments, particularly due to the tariffs. So again, when it comes to China, it depends on refineries. We have government refineries, private refineries. They all have different approach. But yes, China much more slower.
Sarah, thank you so much for that. Sarah Vakshuri of SVB Energy International. Of course, we have crude currently under pressure. Let's do a check on Indian markets. They've been trading for about 6 minutes now. We know the rest of Asia pretty much flat as we await that decision from the Fed. The Sensex currently down by 0.1%. The other benchmarks also under pressure. The Indian rupee trading at 8867. Now, India has labeled Monday's deadly explosion near New Delhi's Red Fort as a terrorist incident. At least 8 people were killed and many more injured when a car exploded, setting nearby vehicles on fire. Let's go to Bloomberg's Sudhi Ranjan Sen in New Delhi. Sudhi, how does India classifying the explosion in Delhi as a terror incident change things in the region? How does it affect where Prime Minister Modi stands?
Well, it makes a huge difference, because we have seen not very long ago, about 8-9 months ago, Government of India and in fact Prime Minister Modi coming out and saying that India is changing its policy in the way it looks at such attacks, such incidents, by saying that any act of terror will be considered to be an act of war. Now, as soon as you classify something as an act of terror, the government therefore needs to take it as an act of war. So therefore the question that arises is, once that is established that this is a terror incident and therefore an act of war, what kind of actions will the government of India go for? In the past, that's in May at least, we have seen India going and striking targets, both targets that it said were used by terror groups, classified by India and some by the UN as well, and also military targets thereafter. So there is this entire question of, does this automatically mean it is going to lead to another escalation, or there are steps, or there is some way to go before it means escalation? That's the question that comes up immediately.
For this particular incident, what could be the next steps, and what could Prime Minister Modi authorize this time?
Well, to be frank, we don't have a clear idea on that. But what we can say after speaking to government officials and the sense we are getting, and also yesterday's cabinet, statement that came out, the one thing that we are likely to see, without any doubt, is that India is going to intensify operations within the country, counter-terror operations within the country, and that would mean that more for common people on the ground would mean more checks, more security being tighter, especially around airports, railway stations. So all that is going to follow. That seems to be the normal, the normal step forward from here. But beyond that, how Government of India is going to handle this, or what steps it decide, is not very clear right now.
Pakistan, without naming India, has pointed fingers to New Delhi. Does that change the dynamics at all?
Well, it does change the dynamics, because, compared to a couple of months ago, Pakistan now seems to be having a very good, tie. Its ties with the United States is very, very good. It also has the backing of China. So 2 major superpowers, so to say, are backing Pakistan, or their relationship with Pakistan is quite good. On the contrary, while India-China relationship has recovered, but it's not, it's on the being normalized, but it's not normal. And at the same point of time, India is having difficulties with the United States. So in some ways, we can say that India stands alone in this.
Right.
So, with Pakistan making these allegations, it does change things a lot on the ground.
Sudhi Ranjan Sen, thank you so much for that. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. President Trump signing a bill to end the longest government shutdown in U.S. history. Welcome back. You're watching Inside. U.S. federal workers have been asked to get back to work as President Trump declares that normal government operations will now resume.
With my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
Let's bring in Bloomberg senior editor Balazs Pence for the latest. Balazs, you heard the man. Get back to work.
That's right. So as we saw just within the past hour, the president signed a bill that ends the longest shutdown in U.S. history after 43 days, more than 6 weeks. So this means that federal workers can start getting back to work. We heard that some of them might get back to work as soon as Thursday U.S. time, although it will take a while before the federal government can be back up to speed after such a long time away. On the flights, which was one of the main focus for everybody after the U.S. had to cancel so many flights because of the shutdown, the government said that it may take up to a week until everything is back to normal and they can lift all the restrictions on that. It will take a while until those federal payments start flowing to people across the United States. It will be a while until federal workers start getting their salaries again. So it will take a little bit of time until everything is back to normal. But as we saw, at least there's an agreement and the shutdown is officially over.
For the markets, Balazs, it is about the data, economic data. Currently, there's a fog, and it's hard to predict what the Fed might do. How much clarity is there? We'll be getting that data.
That's right, Haslinda. There's so much economic data we're missing, from GDP to CPI and jobs all the way down the list. The White House said today that the latest jobs data may not ever get released. So we may need to wait until December when the November jobs and CPI data get released to get any sort of clarity. Markets have been looking for any reason to kind of double down on the idea that the Fed will cut rates in December. And that's the movement that we've been seeing, especially in the dollar. It does look like that's the direction we're heading. Some of the non-government data that we've been getting do suggest that the jobs market has been very weak in the U.S., but clearly the Fed will need more data and an official kind of reinforcement of those data points to be able to go ahead. There's a lot of attention on when the data fog, as you said, might lift, and that too might take a while.
Balazs, it was quite a long comment made by Trump when he signed that bill ending the shutdown. What are some of the key takeaways?
Well, it's really interesting because if you look at it, neither party can be very happy with the political outcome. Of course, the Democratic leadership has been furious at those 8 senators who broke rank and sided with the Republicans to end the shutdown. They feel like they came out weak. They didn't get what they wanted, especially on those Obamacare subsidies. But on the Republican side as well, when you think back to last week and the results of those off-year elections, the Democrats did really, really well. And every indication tells us that the shutdown played a huge part in it and that a lot of Americans blamed the Republicans for the shutdown. So politically, what we see the president doing, he is trying to reframe the question of the shutdown and blame the Democrats, of course, for everything that happened.
Balazs, great perspective there. Bloomberg senior editor Balazs Pence there for us, coming from Hong Kong. We're also tracking moves in the dollar and other major Asian currencies as the U.S. government comes back online. The dollar's outlook will be a key focus given its strength during the shutdown. For more, let's bring in Bloomberg Intelligence Chief Asia FX and Rates Strategist Stephen Chu. Stephen, I mean, you can only imagine this is a positive for the USD.
Absolutely. I mean, in the first half of the year, the dollar was so weak because it's all about the reciprocal tariff. It's all about the credibility of the government of the U.S. dollar. But now everything else is fixed. Now we have trade deals, even US, Korea. Now the government shutdown is over. So actually it's very positive for the dollar. And markets now finally can focus on the most important short-term drivers, which is rate differentials. So unless the Fed turns really dovish in December and signaling more cuts for next year, otherwise I don't see the dollar collapsing from here. It's actually supportive for dollar against Asian currencies.
The question to ask exactly that, the impact on Asian currencies. I posed that question to the Bank of Korea governor just yesterday. Take a listen to what he had to say.
If you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Governor Rhee weighing in on that debasement debate. Your thoughts on what he had to say?
That's exactly the point, because in the second quarter, we saw like dollar dropping. Everybody say, oh, we are leaving the dollar. But the fact is, it's actually an increase in hedging. It's not selling dollar assets because it's still the largest market. Like, where are you going to go if you sell your dollars? So at the end of the day, now we see when everything else is fixed, we just have to stick with the dollar. But that means that for Asian currencies, especially the low yielders, Korean won, Taiwan dollar, and the yen, of course, like they will be under pressure once again.
The question is, how low can they go, and at what level might the central banks come in and intervene?
Now, to be very honest, I think the risk of intervening, especially for Japan and South Korea, is very high. Now, we have a look at our valuation model. Now, for the yen and the Korean won, it's massively undervalued by 15%. Now, these two currencies, they are the weakest Asian currencies in the second half of the year, down by 7 to 8% against the dollar. And if market continues to trade on rate differentials, meaning that that's going to be in favor of the dollar, and the further drop in yen and won, I think, will urge some sort of central bank actions. Especially, we saw like verbal warnings from the Bank of Japan. So the window of intervention will be very close if that continues.
For a currency like the won, could the level of the currency be reflective of its fundamentals or not?
I mean, like, won is always a very interesting currency. Like, if you look at it from a rate differential, like, sometimes it doesn't matter. Sometimes it depends on equity flows. But now, certainly, rate differential is the most important driver. One very important or interesting example is in the third quarter. We are seeing very strong exports. We are seeing a lot of equity inflow. So basically, Kospi was the best performer. But still, the won has been weakening. The reason being that market is now starting to trade back to rate differentials. And also for Korea, there's an extra factor that US-Korea deal, at the end of the day, Korea still committed $350 billion to invest in the US, and that's going to be one negative for the years ahead. So that's why everybody just stay bearish on the won for now.
Stephen, thank you. Stephen Chu, Bloomberg Intelligence Chief Asia FX and Rate Strategist. Let's get more perspective on FX markets with Mittal Kotecha, Asia Head of FX and EM Macro Strategy at Barclays. Let's pick up on where we left off with Stephen, the Korean won. More weakness coming?
Look, short term, we can't rule out a firmer dollar against Korean won, but I would agree. I think, getting these levels between 1460, 1480, there is a growing chance of intervention. There's also a growing risk of MPS hedging, where they'll probably be selling more dollars as we go up through these levels. But look, we're in a broader firm dollar environment. The yen is under pressure, and the yen is also a key factor driving the won weaker. It has a big correlation with the yen. At the same time, Korea is seeing residential outflows that have been pretty aggressive, plus, of course, foreign portfolio outflows. Both Taiwan and Korea have seen substantial foreign portfolio outflows. You add that to the fact that exporters are just, at the moment, sitting on dollars. They're not converting their dollar holdings into local currency. And it means the bias for now still remains on dollar upside against Korean won. But I think to the point that was made, the won is super cheap here. And ultimately, there will be some value in the currency. But again, it's hard to catch a falling knife at this point in time.
And when I asked the central bank governor where he might intervene, he says it's really hard to say because a lot of factors are in play. But he could intervene if there's excessive move in the currency. What's excessive?
Well, I think we're already approaching excessive because it's not just weakness against the dollar that we're seeing here. It's weakness against its peers. And so, it has become one of the biggest underperformers amongst Asian currencies. And I think the risk is that if this sort of move continues, it could get out of control, and then everyone will start focusing on the 1500 level, and that will be, quite an important level if it breaks through. So I think we're getting to sort of levels that are that sort of risk now of increased intervention. And so, we could see, if anything, and as I say, it's hard to catch a falling knife, but we could potentially see some slowing in the pace of dollar appreciation versus the won, and ultimately perhaps some steadying.
Therein lies a problem, right? If it is a function of the strong dollar, there's very little that the BOK can do.
It is true, but again, our models would suggest that even when you look at the dollar moves, for example, dollar yen, etc., that the won has weakened more than you would anticipate based on the rally in the dollar that we've been seeing in the second half of this year. So I would agree with that, and it's hard, obviously, to have a stronger currency with a broad dollar strong background. But at the same time, it's probably moved in excess of what would be expected.
And the BOK, between a rock and a hard place, I mean, what does it do?
It's tough. I mean, absolutely. It's the intervention only works best when you're going with the tide, right? And at the moment, it's against the tide. So it's very hard to intervene, especially if it's kind of a risk of it failing and dollar moving higher. But what it would do is send a signal to the market that, look, enough is enough. That, we are here, we are getting concerned, that we want to at least put a cap on dollar Korea. A classic example is what RBI has done in India, which has protected its sort of 89 level on dollar rupee. So, there is a signaling impact here, even if it's not going to have a pronounced impact on dollar Korea.
It is interesting, markets expecting a cut, but if you take a look at the bond market and where yields are headed, they're actually perhaps suggesting he could be raising rates.
That's right. The market actually is starting to price in hikes if you look at the move in swaps. And look, we think that's being overdone. Our economist still thinks there's a chance that the Bank of Korea cuts still, although it is a closer call. Nonetheless, to price in hikes at this point in time, look, obviously a weaker won is not helping in that respect. But we've actually gone the other way. We've taken a receiver trade on the 5-year NDIRS with the view that the market has been overpricing in potential hikes and pricing out any potential cuts here. So we think that move is also overdone at this point.
And the yen? And what do you see the BOJ doing?
Well, look,
in December, maybe?
Yeah, look, we don't see the BOJ hiking in December. We still think a January move is more likely from the Bank of Japan. Obviously, the political situation has steadied out a little bit now with Takaichi becoming prime minister. We don't see as loose a fiscal stance as was worried about prior to the election, which again may open a little bit more room as well for Bank of Japan to tighten. Inflation still remains relatively elevated as well, growth above trend. So there's every indicator, and of course wages are important here. So there's every reason why BOJ should hike rates in our view. But for the yen at the moment, we're steadying around sort of 155. We probably will see more verbal jawboning if we get beyond this and sustain a move beyond this. We actually have a long dollar yen trade at this point in time, so we still think there's a bit more traction on the upside. And so, near term, it's hard to go against that.
It's strange because in my conversation with former BOJ Governor Kuroda, he talks about the yen possibly getting to 130, 140. What might take it there?
Well, again, like the won, the yen is super cheap. We know that, but I think to get there, you would probably need to see, again, to the point of interest rate differentials shifting significantly in favor of Japan, i.e. the Fed would probably have to cut a lot more, BOJ would probably have to tighten a lot more, and then you might have a stronger move lower on dollar yen. Plus, more broadly, you'd need to see just a weaker dollar environment for that to be the case.
But we're not going to see a weaker dollar environment.
That's not what we're anticipating, no. So I think it's going to be very tough to get anywhere near that 130 level. I mean, look, the other factor could be a major, major risk-off event that results in massive repatriation back to Japan, given Japan's huge net international investment position. But again, doesn't, there's a lot of unknowns out there, but at least from a known unknown perspective, we find it very difficult to see what's going to shake that up to the point where you get massive risk aversion.
Well, people have talked about, the M&A activities.
Sure.
That could drive a lot of money into Japan. That could perhaps provide some buffer and support for the currency.
Yeah, absolutely. Look, if we see a big inflow into Japanese asset markets, and look, equities have done pretty well, and look, there may be some push back if as US yields move lower, the Fed cuts rate, you could see money coming back into Japanese rate markets. But again, you'd need to see a sizable flow for that to have such a significant impact on dollar yen. And at the moment, we're not seeing that, and we're not expecting that.
The other currency we're keeping a close eye on is actually the Indian rupee. We just had inflation reports saying that it is at a record low. Surely that must be some implications on the currency.
Well, I think the implications are more so on the rate side. We definitely think the RBI has now a lot of scope to cut rates at its December meeting. So we're looking for one more 25 basis point cut. And markets have sort of sold off in that way that there may be some room to price in more easing. But I think from an FX perspective, look, RBI is holding the sand just below this 89 level, holding their line in the sand, sorry. And on the problem is every time the rupee strengthens, you're seeing dollar buying coming in through importers. RBI is also picking up dollars to build up its reserves, plus the forward book is rolling off, so there's a dollar demand coming through from that. So it's very hard to see any sustainable rally in the rupee. So for now, we're kind of stuck in this range. As the dollar's going up, the rupee probably outperforms, actually, especially versus low yielders, because of the fact that the RBI is staying there. But I think from an inflation rate perspective, I don't see it having a huge impact on the currency.
Is the rupee at fair value?
Well, it's probably reasonably cheap in our view. In fact, when you look on a near and a rear basis, it is one of the cheapest currencies in Asia at this point in time. Its deviation from a sort of a long-term average fair value is quite significant at this point. So that doesn't mean currencies can trade away from fair value for a long period of time. So we're not saying it's suddenly going to get back to a much stronger level, but it does look relatively cheap here. And from a competitive perspective, you look against the CNH or you look against some of its peers, it has cheapened significantly.
Geopolitics have always played a part in how assets move, and now we have, again, tensions between India and Pakistan. Might that weigh on the currency?
It could do, and certainly if we see further flares up, you might see the way perhaps you see a bigger impact is from the portfolio channel. The portfolio outflows from Indian equities were very significant, have been significant this year. Bond flows have been fairly weak. If you do see a flare up on the geopolitical front, then of course you might see more selling of Indian equities by foreigners. That could then start weighing on the rupee more broadly. And, again, if there is something that ends up being even more heightened in terms of geopolitics, that you may see more dollar demand against the rupee.
Let's take a step back, take a macro picture. In the next 12 to 24 months, given assumptions on the dollar, which are the crosses that you're keeping an eye on?
Well, look, I think the dollar, in our view, is still the view is constructive. We still look for the dollar to pick up momentum into next year. So it's very hard to be long versus the dollar, for most currencies. I think the real theme that's playing out in FX markets is carry. And we would generally one of our sort of biggest trades this year has been a long high carry versus low carry basket of currencies. And I would still suggest that continues to pay dividends in the next several months. Unfortunately for Asia, it's not a region of carry. You only have a couple of currencies that have a decent carry to vol, and we talked about Indian rupee being one of them. But most of the carry can be found in the likes of Hungary, South Africa, or Brazil, or Mexico. And that's where we're seeing a lot more demand in terms of carry trades. So I think that'll be the biggest trade.
So how would you play the Asian currencies?
I think at this moment in time, we probably would look more relative value. Again, low yielders are going to struggle in this environment, and that means the likes of Taiwan dollar, for instance, will struggle. On the one hand, you've got CNH providing an anchor with the PBOC's very firm fixings. On the other hand, you've got a stronger dollar. So more broadly, we'd probably see more dollar upside against most Asian currencies in the next few months.
Can you see the PBOC continue to defend the currency, given that, we're seeing signals of a weakening economy?
I think they can, and they have a lot of ammunition to do so.
Because they've kept powder dry for a very long time.
Absolutely. And, the current account surplus, the external balance in the first half of the year has been super strong. Trade has done very well despite worries about tariffs. And so there is plenty of strength in the external side. And, of course, the fixings are working well. I mean, PBOC keeping very firm fixings, around this 609 or 709 or below levels has really helped. Plus, state banks are also intervening. So I don't see an issue there. But the question will be, as exports start to fade, will they want to see a weaker currency to keep competitiveness up. And I think at that point we might start to see that happening.
Especially when it's selling those cheap products to, countries in this part of the world.
That's right. Look, I mean, there is still an excess capacity issue. Anti-involution is trying to remedy that, but it's slow process. It's not really helping that much. So I think China continues to export a lot of its goods to Asia. Some of that's being re-exported to the US, but it's dampening down inflation in a lot of Asia.
Which Asian currency is most vulnerable in 2026?
Oh, that's a really good question. Look, I think, as I said, I think low yielders are going to struggle.
If you had to pick one?
Look, our view is, we still see more downside in, as I said, probably looks like Taiwan dollar. Yen will be another one where we see, broadly more weakness coming through into next year as well.
My producer's asking me to ask you about the Fragile Five.
Oh, okay. I mean, they are less fragile than they once were, I think. I mean, why were these currencies seen as a fragile five? External imbalances, fiscal imbalances, worries about capital outflows and volatility. A lot of that's faded now. So structurally, the fragile five, so no one really talks about that because it has really become a case where they're much, much less fragile. And actually, if you take a much broader picture, we take the G10 versus EM. A lot of EM now look much more developed than a lot of G10. Right, and I think, in that sense, if you look at FX volatility, where is it super low? A lot of EM volatility is very low compared to G10. So I think the tables are starting to turn at this point.
In fact, there's been a lot of vol in the USD.
Correct, that's right, exactly.
Mittal, thank you so much for that. Mittal Kotecha of Barclays. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here's a look at the Indian markets. It's trying to eke out some gains. The Sensex currently, though, pretty flat. India's inflation at a record low, fueling that bet that the RBI will cut rates even more. As it stands now, the rupee, of course, is front and center. Some say, though, like ING, expecting a rebound for the currency as the U.S. and India work out the differences in terms of their trade negotiations. Prospects for the Indian rupee, according to the ING, is looking pretty good in 2026. Now, let's do a check on the situation in India. Let's get to Bloomberg senior India economist Abhishek Gupta in Mumbai. Abhishek, I mean, we have inflation at a record low, food deflation. What does it all mean for the economy, particularly for the farmers?
Thanks, Haslinda. So, yes, inflation came at a record low at 0.25%. We and the consensus were expecting 0.4%. And this suggests that inflation might once again undershoot RBI's projection. RBI has already lowered its inflation projections for the full year. It started at 4% in April, and now it came down to 2.6% at the October review. And the current price trends suggest that inflation could even undershoot this. In fact, my own projection is 2.1% for the full year, and I am seeing downside risks even to that number. This inflation number, which also included 3.7% deflation for food prices, is really tricky because the farmers and then the rural economy will now have terms of trade turning against them. So part of the recovery this year was being driven by strong rural demand. And if inflation stays low, then that support to the economy is going to sort of no longer be there. And at the same time, if RBI is not going to be cutting interest rates, then the positive impact of low inflation will also kind of be not there for the economy.
Right. The thing is, inflation staying below 2% for a second straight month. Do you think the RBI's inflation mandate is at risk?
So RBI's inflation mandate is that inflation should not lie outside its 2% to 6% target range for 3 consecutive quarters. Inflation has already undershot 2% on average in the previous quarter. In the current quarter, it's looking like it might average around 1 to 1.5%. And so there's a real risk if this food deflation continues for a few more months, especially in 1Q 2026, if inflation numbers do not turn up over 2%, then there could be a real risk that RBI actually might miss its inflation mandate. And that's what leads us to think, why has RBI not been cutting interest rate? Why has it been delaying resuming its easing cycle?
So do you see that rate cut happening in December?
Absolutely. So RBI at the October policy indicated that there is room for easing interest rates. The Deputy Governor has also, after that, suggested that there remains room for cutting interest rates. And it's widely believed that with inflation so low and risks to growth still there, with the trade deal not coming through so far, that the RBI will need to provide more support to the economy. We certainly expect, we've been in fact expecting inflation, the central bank to start cutting rates. And we think that the RBI will not just deliver 25 basis points rate cut at the December review, but also change its stance to an accommodative stance, which will then lead the markets to price maybe another rate cut at the February meeting as well.
Great stuff. Abhishek, thank you so much for that. Bloomberg senior India economist Abhishek Gupta. Well, it's a big day for China earnings led by Tencent, whose AI investments and gaming ventures will be under scrutiny. Analysis coming right up with Bloomberg Intelligence. Keep it here with us. This is Bloomberg. Let's do a check on Samsonite shares trading in Hong Kong, surging as much as 26%. It's currently up by about 18%. And that's on the back of management expecting sequential sales growth improvement in the fourth quarter. We've also had the likes of Jefferies upgrading that stock to a buy from hold. It cited a positive outlook for the fourth quarter. Again, Samsonite, having a massive run today, higher by as much as 26%, currently up by 18%. We're also tracking trading in Chinese tech firms, the likes of Tencent and JD.com ahead of earnings later on. Tencent in losses right now, down about 1%. JD.com lower by about 2%. They're set to report earnings later today. Well, for more on what to expect from Tencent's earnings, let's bring in Bloomberg Intelligence senior analyst Robert Lee in Hong Kong. Rob, what are we expecting? What kind of numbers?
Okay, well, as you know, Tencent's the biggest stock in the market here in Hong Kong. It's a very well-diversified business. It has market leadership in most of its divisions. So it's a relatively low, dependable, safer bet relative to many of the other names in the China tech sector. So Tencent usually delivers. We expect that to be the same. Numbers are going to be in line or slightly ahead at the margin front. It's a sort of steady-as-you-go sort of message. Whereas our friends at JD.com, given the ongoing pressures in e-commerce, etc., are likely to report a more challenged outlook, I think.
And they've had a massive run, especially Tencent. I mean, is that sustainable going forward? And when you take a look at the AI space as a whole, people are talking about concentration risks, even for those trading in Hong Kong and China. Okay, well, if you compare with maybe US peers, the valuations that China Tech trades on, Tencent in particular, are at a significant discount. Whilst the sector has re-rated and the stocks have rallied quite well this year, I mean, Tencent is up over 50%. We're still trading at a discount to historic levels. So I think that's the first thing I'd mention. And also, if you look at the levels of CapEx investment, particularly on the AI side, if you look at the three big hyperscalers in China, so in other words, Alibaba, Tencent and Baidu, they're due to spend around $30 billion on CapEx this year.
Compare and contrast again with the US peers, we're spending somewhere close to 10 times that or greater. So China's approach to AI is on a budget, if you like, and they're focused really on the nationwide rollout of AI, a more sort of pragmatic strategy that stands to deliver more immediate results in terms of boosting productivity across the economy as a whole. And also coming back to Tencent, Tencent's more focused on using AI to enhance its existing businesses rather than focused on external cloud markets. And just very briefly, the issue with the external markets, particularly cloud computing in China, is the levels of competition are cutthroat. The margin pressure is intense. So Tencent is less exposed to those external dynamics. And therefore, again, that's another factor which makes it, the mutual fund manager's friend. This is a company that has got a consistent track record. It's defensible growth, in other words. That's what you get with Tencent.
You talk about the approach to AI. People draw the distinction between Tencent's approach to AI versus Alibaba's approach to AI, and that may have implications on their returns. Talk to us about that.
Okay, again, if you look at the numbers, and for any clients, you can look at the terminal function MODL to see these numbers. The core of Alibaba's business remains tied to e-commerce. So the substantial estimate downgrades we've seen for Alibaba this year, again, are almost solely driven by e-commerce with the ongoing margin pressure, competitive pressures we're seeing in that market. Obviously, there's some tariff impact from the US, etc. Tencent is far less exposed to those pressures than Alibaba. And then the second thing about Alibaba, whilst it has a greater relative percentage exposure to cloud, and it's the cloud numbers which have been exciting investors. Again, taking a step back, in reality, cloud is not a big enough part of the business to move the needle at Alibaba. So what I'm trying to say is that Alibaba's business and its earning outlook, it really does remain tied to e-commerce. We've got a very intense price war in the China e-commerce space. We've got the tariff uncertainties. We've got a lot of margin pressure. Tencent doesn't suffer from any of those external pressures or risks. It's a much more defensive business. It's got global leadership in video games. The WeChat app is a ubiquitous part of life in China. It's a very solid, dependable company. To give you an analogy, if Tencent was a dog, this is a bit of a weird one, it's the German Shepherd. It's the Black Labrador, the dependable friend, the mutual fund manager's dependable friend.
Are there risks, Rob?
For Tencent, there's risks with everything. So again, I'm not in any way brushing over the risks. The risks for Tencent, previously their business model was more driven by external acquisitions. So given the geopolitical environment we're in at the moment, it's very difficult for them to make any meaningful acquisitions. And also there's the ongoing tariff pressure, which, as I've just argued, is probably a lesser risk to them, but they're still exposed. And then I think, as China's largest listed technology platform, depending how the geopolitical situation develops over the next year, then, Tencent, I would imagine, would be potentially target number one. And we did see them, and people maybe forget because so much has gone on in this year. Back in January, they were added to the Defense Department's sanction list, although that hasn't really had any impact on their business directly. So I think there's ongoing political risk there. But from what we know and understand at the moment, again, not brushing aside risks, this is a well-diversified, steady, high-quality business, high-margin business, which should continue to deliver from where we stand at the moment. Alibaba, compare and contrast, is far more high risk in terms of their strategy, their chance of realizing on their high-risk AI cloud strategy. So no wonder I think most mutual funds have got a higher position in Tencent relative to the latter.
Great insights, Rob. Thank you. Bloomberg Intelligence senior analyst Robert Lee there. Now to India. The Economic Times is reporting that Biocon is exploring a potential merger of its biosimilars arm, Biocon Biologics, with the parent company. It's a deal that could value the unit at around $4.5 billion. Shreehas Tambi is CEO and Managing Director at Biocon Biologics. Shreehas, good to have you with us. Why does this merger make sense?
First up, Haslinda, thank you for having me. And I think I wouldn't want to comment on this piece because there is no new development at this point in time that we have to share or report. If you look at what we've disclosed in the past, is the Biocon Limited board had set up a committee that was probably a couple of quarters ago to look into various options of unlocking value in the investments that it had made. And Biocon Biologics was one of its incubation of businesses that it had done. IPO was an option, and there were other options, including a merger that the committee was tasked to look into. At this point in time, there is no update on the committee coming back to the board and recommending any particular option. So unless that happens, we would be able to comment on anything specific on where we are headed with this.
It all comes down to growth, and growth is looking pretty good. In fact, you saw robust growth, the fastest among all the Biocon's businesses this quarter. What's behind that growth, and how will you sustain that?
Yeah, I think the growth's been very consistent. We've been on a growth momentum that we maintained for the last 7 quarters since we became a fully integrated company, commercializing in over 120 countries. This particular quarter that ended September of 25 has been particularly remarkable, where we've seen 25% growth in the revenues, and the EBITDA has grown over 40% as compared to the same quarter last year. So it's been remarkable. What's really underpinned that growth is the increase in market shares of all our established products that we've been growing over a period of time. North America has been a strong performer for us. It continues to be a strong region, continuing to contribute over 40% of our revenues. Europe continues to be a big upside now, where we've seen market shares in our oncology franchise, which was under 10% to now going over 20% this quarter. So that's been a strong growth driver. And we are starting to see some initial effect and benefits of our new launches, which will actually play out to its fullest in the coming fiscal.
You talk about how you're doing well in the U.S. market. It accounts for about 40% of your sales. Has that been impacted in any way at all by, the tensions between the U.S. and India?
Not at all. Actually, if you look at it, we are a part of the solution that the administration's really been focused on. If you see what the administration has particularly said in the U.S., is they are focused on making America affordable again. And the generics in the biosimilars industry is on the right side of that conversation, because it's over 50% of the drugs that are sold in the U.S. are generics. And they actually maintain the health of not just the U.S., but of the planet. So the generics industry has always been excluded from any of these tariff discussions, because they actually work in favor of the agenda to make healthcare affordable again.
So you're not too concerned about the proposed tariffs? You're not too concerned about the F&N pricing as well?
We've been concerned about it, but we don't see an impact on the industry that we operate in, because we are essentially part of the solution, like I said. And we see the commonality in terms of the mission that we have as a company to transform lives in healthcare and bring high-quality, affordable products to people around the world, in terms of what the mission of the administration is. And which is why we're not too concerned about that part or being adversely affecting us.
Given the optimism, do you see perhaps the business in the U.S. growing even more? If you talk about how it's currently contributing 40% of the sales, can you grow that? What does it take for you to do that?
Yeah, and it brings me to a very important point. As we ended last fiscal, we had guided that we are going to be bringing 5 new products to the American market, and what we've done in the first 2 quarters is we've been able to bring 4 of those 5 products to patients already, and part of it is what's starting to play out at this point of time in our numbers. But importantly, until last year, we had 4 products that we were commercializing in the US. Now you're going to see at the end of this year and early next year, you will have 5 more products to the 4 products that we had commercialized previously. So clearly, the future is far more exciting than the past we've had so far, which isn't too bad.
How will those new products contribute to your numbers going forward?
So if you look at the products that we are bringing to the market, if the products are in 3 broad categories, and there's a new therapy area that we are getting into. We are focused on debilitating diseases, if you know where we are invested in. We are bringing products in the oncology space. So we strengthen our oncology franchise, where we already have over a fourth of the US market with the products that we currently commercialize. And we're bringing another product into that franchise, and we expect it to complement whatever we've already got there. We have the other franchise, which is the insulin's diabetes franchise, where we really are working very closely with the administration. We just signed up with the state of California for a CalRx branded insulin glargine, which is a very special, I would say, a pioneering kind of a transaction, which is product getting directly to the pharmacy that allows patients to access insulin glargine at a very, very affordable price, which is what Governor Newsom announced recently. We don't see any other biosimilar interchangeable competition. So that's a very, very special piece there. And the autoimmune space, which is, again, another chronic area where we are focused on. You'll see products being launched there, and our market share is increasing as well.
Shreehas, we know that Biologics is looking to IPO. Where are you with that plan?
Like I said before, Haslinda, we've created a tremendous amount of value in the business, and this is what Biocon has done over the years. It's incubated several businesses. The generics business, which we listed in 2004, we listed our research services business in India in 2015, which is roughly 10, 11 years after that. We also recently listed our novel biologics business on NASDAQ, which was another $1 billion listing. So it's very clear that we are looking to unlock value in terms of what we've done at Biocon Biologics. I told earlier on the show that the committee is looking into what's the right way to monetize it. And as the committee concludes its recommendation, we'll be able to share with you what approach Biocon Limited is going to take on this particular aspect.
Shreehas, let's get your view on how the Indian rupee is trading. Given that you do business internationally, we have a currency that's hovering at record lows, close to record lows, and inflation at record levels. How are you squaring that, and how is that playing out in terms of your business?
Purely from a business and not discussing specifically on the currency, given that from a business standpoint, most of our business is dollar denominated. We do have a split where the US business is a little over 40%. Our European business is in that 30-35 range. The rest of the world is about 23 to 25% of our revenues. Most of our business is a dollar denominated business. So we do not really see much of an impact on currency, and inflation is something that does impact buying overall, but it's not on healthcare. So that's not an area that you go to first when it comes to rationalizing of spends. We've not seen too much of a movement in terms of currencies making a decision on how it will impact our business going forward. So we're pretty insulated from devaluation numbers.
Right. I'm just wondering whether you see record low inflation forcing the hand of the RBI.
I wouldn't comment on monetary policy at this point in time, but it certainly has been favorable overall if you look at it in terms of availability of credit. And things have moved so far. Most of our borrowings have not been in Indian currency.
What risks do you see for the Indian economy?
I think at this point of time, the Indian economy is in a very good place. If you look at how the overall space has evolved, it's probably never been stronger. Companies have grown. There are several sectors that have shown tremendous growth. And if I talk about specifically where we are at this point in time, buying power has increased. There's more money in the hands of the consumer. So there's clearly an uptake in terms of the sentiment and in terms of how the policies have shaped up. So I would see that the economy overall has been looking up for the recent past as well.
Shreehas, thank you so much for that. Shreehas Tambi, MD and CEO at Biocon Biologics. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.